Hello options traders and happy Friday everyone. And I just wanted to post a quick video here in response to a question that we got from a previous video. And one of the traders in this group asked, well, is there an assignment risk with a vertical spread? So if I've got this vertical spread on here, I've got a long and a short position, what happens if I get assigned early? And is that going to pose a risk? And a lot of traders think that this is the case and they avoid potentially very good trades because they're afraid of this risk. Well, let's take a look and see what actually happens if you get assigned early on a long vertical spread. Now, for this example, I'm just going to be talking about one specific case, but you can step through the motions yourself and you'll find out you're going to get the same answers. But let's just assume that we buy a call spread. So we're going to buy the 100 call and sell the 105 call. And let's just say that it's done for a net debit of 3. Well, if I do this trade, this is my resulting profit and loss diagram. I've got a maximum loss of 3 and a max gain of 2. And again, we can see that one of the keys to understanding this video here and why it's so important to understand your synthetics is that I have limited losses on this side and I've got limited gains over here. So again, this is where traders say, but if I get assigned, this is no longer going to be true, so it must be a risk. Well, let's take a look. If you get assigned, you really have two choices. And the first one is quite simple, so let's start with that one. Let's say that you're short the 105 call in this example. And if you get assigned on that position early, what it means is that you are going to have to sell 100 shares at the strike price of 105. So if you don't have those shares, what happens? Well, now you're short 100 shares at 105. But remember, it's not just the short shares that are now in your account. You've also got $105 cash because the person that exercised early has to pay you that strike price. So we're sitting on $105 cash per share, or $10,500 for the entire lot. What's the first thing that we could do? The simplest thing to get out of this? Just simply exercise your $100 call. Where will you get the $100 cash from? Right there in green. It's sitting in your account from the early exercise. So all you have to do is push the button that says exercise my $100 call, and guess what happens? You collect your $2 maximum gain early. There's no chance for that vertical spread to now lose. So it's a huge gift. If somebody exercises early, if you just want to be done with it, turn right around the next day once you're notified and just exercise your call, and you'll get your maximum gain early. No risk whatsoever. However, there's a better choice. So let's take a look at that. When you are short your 100 shares at 105, remember this is the resulting position from that early exercise. But you're also long the $100 call. That was part of the original vertical spread. And if you understand your synthetics, you'll see that the combination of these two pieces right here is exactly the same thing as a $100 put, or in the business as we call a synthetic $100 put. So by a synthetic, it means it's not really a $100 put that's sitting in your account, but it looks, acts, feels, behaves just like a $100 put. So for practical purposes, it might as well be. Now, if synthetics is a new topic for you, I do have a complete video here on synthetics. I'll give you some more details on that if you want to look that one up. But the main thing to understand is that we have unlimited profit potential from a put. See, when I had that vertical spread, that's not true. I had limited profit potential. So once I get the early exercise or the early assignment right here, what happens? I move from this blue curve, that was my original vertical spread, to the red. And you can see that I've got unlimited downside potential, at least down to a stock price of 0. But when I had the vertical spread, it was absolutely capped at $2. But see, that's no longer true. And in fact, let's get rid of that one right there. We can see that we've got this little wedge down here in green. The entire resulting curve sits above 0. And in fact, the size of that green box right there is $2. So what this tells you is that you're guaranteed to make at least 2, which wasn't true before when you had the vertical spread, but we might make more. So once you understand the synthetics, you can see you're much better off just holding this position, treat it like a lottery ticket, and hope that that stock falls. But what happens if it doesn't? Well, again, remember what happened. Step through your emotions. You received $105 cash from that early exercise. All you're going to do is to exercise that $100 call. It's exactly what we did for the first choice, and that gives you your $5 gain. So the point is that you can exercise at any time to guarantee the $2 gain. So why rush it? So the point is, why should I exercise immediately once I get my assignment notice? I might as well just wait to see if the stock falls. Because if it doesn't, I can always turn around and exercise and get the $2 gain that was going to be my maximum gain anyway. So once you understand synthetics, you'll see that an early assignment is not a risk. In fact, it's a gift. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.